Life insurance is protection. It creates an estate. It pays when the insured dies. Straight whole life is a permanent life insurance policy that has cash value with the premium that is paid each year until death or age 100. Straight whole life is also called traditional whole life or ordinary whole life. Straight whole life has a level death benefit and a minimum guaranteed interest rate. The premium for whole life goes into the insurance company's general account. The insurer has the risk in the general account since they have made a promise to pay a minimum guaranteed interest rate. Whole life provides protection until the insured dies or reaches age 100. If the insured lives to age 100, the insurer will pay to the insured the policy cash value, which will be equal to the face amount. Whole life policies have cash value that grows over time. Included with the whole life policy must be a table of guaranteed cash value for the first 20 years, as of the policy anniversary date. The table will show the cash value per $1,000 of protection. This table must include the interest rate and mortality table used. Limited pay life policies are whole life policies with limited pay-in periods. All whole life policies reach maturity at age 100, even limited pay policies. Whole life policies' cash value will equal the face amount at age 100. A 30-pay life purchased at age 25 is a whole life policy that will require premium payments for 30 years until the insured is 55. The policy will reach maturity at age 100. A single premium life policy is a whole life policy that is paid up for life. Single premiums are the only type of whole life that have immediate cash value. When a life insurance policy has cash value, the insured may access that cash in the form of a loan. If the insured dies with a loan outstanding, the insurer will pay face amount minus the loan plus interest to the beneficiary. Loans are not taxable. Life insurance death benefits are not taxable to the beneficiary. A person with a commission-based job has a fluctuating income, making them a perfect candidate for adjustable whole life. Universal whole life is tied to current interest rates. Universal life is also called interest-sensitive whole life. Universal whole life has two death benefit options, A and B, and a flexible premium. Universal whole life will not lapse due to non-payment of premium so long as there is sufficient cash value to cover the expenses deducted. Variable whole life is an insurance and securities product. Insurance is regulated at the state level, and securities are regulated federally by the Securities and Exchange Commission, the SEC. The SEC oversees the securities industry. To sell variable products, a person must hold both their life producer licenses and be registered with FINRA, passing the SIE exam and either their Series 6 or Series 7 exam. FINRA is a self-regulatory organization that oversees firms and their investment professionals. Premiums paid into a variable life insurance policy go into the insurance company's separate account. It invests in the stock market, earning a variable rate of return. There is no guarantee in the separate account. The insured has the risk. When purchasing variable life, the minimum death benefit is guaranteed, the policy's face amount. It is possible that more than the face amount is paid, depending upon the performance of the separate account. Variable whole life policies have a fixed premium. Variable products are not covered by the state guarantee fund. Variable universal life insurance has a flexible premium and allows for the insured to self-direct funds within the separate account, the only life insurance policy with this benefit. Equity indexed life insurance policies are not securities. An equity indexed life insurance policy has a minimum guaranteed interest rate with the potential to be credited with additional earnings depending on the performance of an index, most commonly the S&P 500. Term insurance is pure protection. It has no cash value. It is the least expensive policy in the short run. A level term policy will have a level premium and face amount for a period of time. A 30-year level term policy will have a level premium and face amount for 30 years. Term to age 70 would be a level term policy that has a level premium and face amount until the insured is age 70. Decreasing term is a term insurance with a level premium but a decreasing face amount. Decreasing term is sold to pay off a loan balance if the insured dies with the loan outstanding. Credit life is a type of decreasing term insurance. If an insured with credit life dies, the loan balance is paid off by the insurer. The creditor is the beneficiary on the credit life policy. When purchasing credit life, the policy limits cannot exceed the loan balance. A return of premium term life policy is protection during the term with a return of premium if the insured does not die during the policy period. The return of premium is not taxable to the insured since individual life insurance premiums are paid with after-tax dollars. Annually renewable term is a one-year term insurance policy that may be renewed, regardless of health, each year by paying the next year's higher premium. Group life insurance policies are often annual renewable term, or ART. Renewable term is renewable regardless of health. In order to renew a renewable term policy, the renewal premium must be paid. The premium for renewable term is based on the insured's attained or current age. Term insurance may be converted to whole life insurance regardless of health. An insured converting from term to whole life can convert the original term insurance policy's face amount, but not more. Annuities are the opposite of life insurance. Annuities systematically liquidate an estate over time. Once annuitized, annuities pay a dollar amount monthly until the annuitant dies. When a client is worried about outliving their savings, an annuity is a suitable recommendation. One of the payout options on a life insurance policy is to choose an annuity. The owner and annuitant are often the same person, but they may be two different individuals. An annuity may be funded with a single premium. A single premium annuity may be immediate or deferred. An annuity may be funded with a flexible premium, allowing the annuitant to pay in whatever amount works for them. Annuities are paid in with after-tax dollars, non-qualified annuities. Annuities are retirement products with early withdrawal penalties if earnings are taken out under age 59.5. With a single premium immediate annuity, the payments start monthly for life 1 month after funding. A deferred annuity always has a beneficiary during pay-in. If the annuitant dies before annuitizing, the beneficiary will receive the account balance or premiums paid in, whichever is greater. If there is no beneficiary listed, the value will be paid to the annuitant's estate. Taxes will be paid at the estate level. An annuitant with a deferred annuity may choose a partial or full withdrawal. Partial withdrawals are taxed LIFO, last in, first out. Earnings come out first. Earnings are taxable as ordinary income. If the annuitant is under age 59 and a half at the time of a partial or full withdrawal, the earnings are also subject to a 10% early withdrawal penalty. A fixed annuity promises to pay a minimum fixed interest rate. The money is held in the insurer's general account. Fixed annuities have inflationary risk. Fixed annuities are backed by the State Guarantee Fund. A variable annuity has no guaranteed interest rate. The money is held in the insurer's separate account. Variable annuities are insurance and securities products. Variable annuities are a hedge against inflation, but only suitable for clients who are comfortable with the risks. Variable annuities are not covered by the State Guarantee Fund. Indexed annuities are not securities products. They include a minimum guaranteed interest rate along with the ability to be credited with additional earnings depending on the performance of the index, typically the S&P 500. During pay-in, the value of a variable annuity is expressed in accumulation units. During pay-in, the earnings are tax-deferred. During the first years of a deferred annuity, the contract includes surrender charges as an incentive to leave the balance alone. During payout, the value of a variable annuity is expressed in annuity units. An annuity can be annuitized at any age. There is never a penalty. An annuity does not have to be annuitized. The life-only or straight life payout option has no beneficiary. It has the highest risk to the annuitant, thus it has the highest monthly payment. When choosing a period certain payout option, there is a beneficiary for some of the money. The payout option with the least risk is the refund annuity. If the annuitant dies before the insurer expects them to, the remaining account balance will be paid to the beneficiary. Spouses who would like the annuity monthly payment to last until the last one dies would choose the joint and survivor annuity payout option. In determining the amount of monthly payout from an annuity, the insurer will use an annuity table. Factors that go into determining the amount paid monthly include annuitant's age, gender, account balance, whether the annuity is fixed, variable, or equity indexed, as well as the payout option selected. Annuity tables are different from mortality tables. Life insurance underwriters use mortality tables, specifically the 1980 ISO mortality table. Life insurance is protection. Combination plans allow for life insurance coverage on 2 or more people, generally spouses. A joint life policy will pay when the first spouse dies, often called a first-to-die policy. Survivorship life pays when the last spouse dies, also called a second-to-die policy. Survivorship life is often sold to fund estate taxes, since if estate taxes are owed, they would be due at the death of the surviving spouse. Juvenile life is a whole life policy on a minor under age 16 purchased by a parent, grandparent, or guardian.